Most traders try to use indicators, but they don't realize they're doing it all wrong. Unfortunately, they don't understand that terms like leading and lagging are actually mathematically incorrect, and they don't know how to combine indicators for the best results. In this video, you'll learn exactly what you're doing wrong and how to create killer combos that work. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005, and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional proprietary trader on our desk so you can grow your trading account.
So there seems to be a huge misunderstanding about the terms leading and lagging indicators. In fact, these terms are mathematically inaccurate. Some traders pride themselves in only using leading indicators. Maybe you're one of them. Some people like to use everything, right? But we break these into buckets. But let's be real, nothing, and I mean nothing, including price action, is truly leading. So in this video, I'm going to outline the fundamental difference between what it means to be a leading or lagging indicator and demonstrate how to use them together to our advantage, and outline why it might be best to just throw these terms out altogether. And also the better approach to get indicators to work for our strategy. And at the end, I'll describe how I used indicators in a strategy to help improve the performance of my strategy. So let's first define leading and lagging and explore the difference between these two families of indicators. There's a clear line in the sand between leading and lagging, and that line in the sand has more to do with your specific application for the indicator than it has to do with the nature and the power of the indicator itself. So let me get into this. So we have our leading indicators, right? This could be RSI, a stochastic. So in theory, leading indicators anticipate. So they'll produce a signal that allows traders to anticipate before the signal move is made. Therefore, leading indicators serve as a heads up. But they can be noisy, of course, and they can be early, which in many cases is the same thing as being wrong. And, we should never blame an indicator for being wrong. Indicators are not traders or strategies. They're just math, just a data point, so we should forgive them. So leading indicators are usually overbought, oversold signals, right? Traditionally, this is how traders classify them. And I'll show in a bit how this might be misguided. Some examples of indicators that are thought to be leading are RSIs, stochastics, market breadth, a Bollinger Band squeeze, maybe even pivot points, trend lines, support and resistance, other price level indicators, things that can give us a heads up before a move happens. And then we have our lagging indicators, right? So things like exponential moving averages, MACDs. So we have, in theory, these lagging indicators that confirm, right? They produce a signal that allows traders to confirm a move after the move has started. Okay, so they're delayed. They're meant to remove noise, and they, of course, can also produce false signals, and they can give us some whipsaw, right? Just like all indicators can. So lagging indicators are usually trend indicators. They're usually some kind of average. So a moving average is the classic example of a lagging indicator. Some more examples of lagging indicators would be a MACD, right, which is a derivative of a moving average, an ATR trailing stop, maybe even your actual stop, right? Maybe VWAP, right, because that's an average as well. So what we want to do, if we're going to subscribe to this theory, is that we want to combine leading and lagging indicators, right? So they serve different purposes. So it would make sense for us to combine them. So we can combine them to help us anticipate, right? So flag a pending move with the leading indicator, and then remove noise and confirm with the lagging indicator to get a clear trigger signal that our move is underway. So let's, in this example, combine an RSI with a MACD to demonstrate this. So here we get the RSI oversold signal as we come into the low, and then after price turns up and we get the trend confirmation from the MACD. right? And if we look to the right on the chart, notice the overbought signal in the RSI gets completely run over by the strong price action here. And this happens a lot on single time frames in leading indicators. So, is there a better way to think about this? In my opinion, absolutely. Right? So the key for me lies not in the indicator itself that we're using, but in the way that we're using the indicator. So let me explain that. So when it comes to the actual indicators, we could argue all day about which is lagging, which is leading, and which is better, but none of this matters to me. I don't find it productive to think of it this way. All indicators and all market-generated information for that matter are based on historical data. So of course, we all know that nobody has information about the future, and the best we can do is observe current values or measure a variable over a historical look-back period. So if we're looking at price action, we're looking at historical bars on a chart. If we're looking at the tape, we're watching the current bid and ask and the current prints. If we want to quantify more about the tape, we can measure volume on the bid and ask over a historical look-back period. And for volume, we can look at the last trade, the most recent minute, measure an average minute over look-back period. You get the point. So everything we're looking at has already happened because there is no future. So if we're looking at an indicator, whether it's measuring volume, price, market breadth, relative strength, we're measuring based on history. So this means that even our favorite indicators are driving their signals based on the past, like never the future. So let me demonstrate in a second how the lead or the lag of the indicator just comes down to the time frame and the look back period used in the calculation, right? So I'll say it again, the difference is in their application, not their quality, speed, or predictive power. So let's compare some indicators that are thought of as leading to indicators that are thought of as lagging, and we'll kind of demystify this whole leading, lagging thing. Here's an intraday chart of NVIDIA with a MACD with default settings, right? That's 12, 26, and 9. And then a stochastic with default settings at the bottom. So 10, 10 for both periods. So this is a classic example of what is traditionally thought of as a lagging indicator in the MACD versus a leading indicator in the stochastic. So we can see here that the stochastic becomes technically overbought during the area on the chart marked by the blue box. And this is thought to be leading because it foreshadows a reversal. And in this case, it was correct. So price did reverse off the high after the stochastic provided a signal. And we can also see that the MACD confirmed this turn after the fact at the point of the blue dotted vertical line. It lagged price and provided a signal quite late, about 4 bars after the turn. So what happens if we change these default settings in the indicators? What if we made the MACD faster and the stochastic slower? So let's change the MACD to a 5, 8, 3 setting, and we'll change the stochastic to a 53 setting. So now we can see that they're almost identical. In fact, both indicators turn down at the same time. They turn back up at the same time, right? So both marked in the blue vertical dotted lines there. So this demonstrates that the leading lagging effect has nothing to do with the indicators themselves. It has more to do with how fast or slow we make the settings and how we use the indicators. So neither indicator is inherently leading or lagging. Both are based on historical prices, which makes them both lagging. And if we want to be super literal about it, both represent current values of what they're measuring. So what do we do with this information? Why does this matter? Right? So here's my little soapbox moment. So we need to completely throw away our terminology leading and lagging indicators, clearly, and focus on the math behind each indicator and understand what it is measuring for the strategy that we're testing, right? So know the math, know the strategy, and know what you're trying to measure. That's it. Keep it super simple, right? Don't even use an indicator if you don't have those questions, right? So for me, this helps me understand why I might use a specific indicator in a strategy or model. Every indicator every tool in statistics for that matter is a current value based on historical data. So this could be a current average, a percentage, a ratio, a special formula like RSI. So to me, the terms leading and lagging are not helpful. So let's kind of go over how I use indicators in a strategy and just like how I set this up in terms of my process. I look at the strategy first and I ask the question, what needs to be quantified about this strategy? How can I measure the market dynamics at play? The market dynamics that are important to my strategy. And here's how I typically break down the different market dynamics. So here are a few. So we have trend, momentum, volatility, volume, areas of interest, market breadth, relative strength, and sentiment. And I want to combine signals that give me a context, maybe a heads up, and some confirmation, right? Or an entry trigger, an exit trigger. So I don't want to be measuring redundant variables. And every strategy is different. So these are going to change depending on the strategy. So here's a recent strategy that I tested, working on a model here. And I had a buy signal. The signal came when the stock gets above the 5-minute opening range. And I knew that this strategy alone wouldn't perform well with only this information, right? This is not nearly enough. So I asked myself, what if it's in an uptrend on the daily chart? What if it's doing higher than average volume? What if it's one of the strongest stocks in the market on that day? And what if the sector that it's in is also strong? And what if the market breadth in the overall market is also strong? So here I'm combining trend, volume, relative strength, and market internals. So I'll use a moving average to define the trend, RVOL to define the volume. I'll use ATR to define the relative strength, and the advanced decline line to define market breadth. So the key for me is that these indicators are specific to my strategy and they are all measuring different market dynamics. So I combine them, and it might take some work to figure out the best ways to measure these dynamics. And then I'm able to improve my strategy. So this went from taking about 2,800 trades over 2.5 years to taking 700 trades. So these variables cut out more bad trades than good trades, and this still isn't the best strategy, and it's in sample, right? So, but it's progress, right? This is just part of the process. So for me, the moral of the story is getting caught up in whether my indicator is leading or lagging and whether one is better than the other is counterproductive. Setting out to measure market dynamics that are important to my strategy is productive. An indicator itself is never an answer to trading as a whole. They're not strategies. So we shouldn't really have opinions about which indicators are good or bad. But within a strategy, there might be an indicator that serves a specific role that helps improve the strategy. That's why I stopped putting so much weight on the indicators themselves and started thinking more about my strategy and how to define it.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training.
That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.